Hey everyone, so the reason I've been getting into bonds is I've actually just spent a week with my uncle and he loves this macroeconomic stuff, talking about the economy and the direction it might go and all the variables that the Fed and the Reserve Bank of Australia have to think about. He loves all that. Now, this is for me way outside of my comfort zone, but here is maybe a reasonable summary. So history would tell us that things revert to their mean. And it appears likely that regardless of what levers the Fed pulls, overall valuations of the index, well, it needs to be related to the output. What I mean by output is the output of the underlying businesses and what they can actually produce. So therefore, in order to keep things really simple, I would refer to what they call the Buffett Indicator, which compares the Wilshire 5000 index to US GDP. So the mean historically should be around 120, and today we're at 166. That's down from the highs of well over 200 back in 2021. Now, I don't exactly know how this will pan out, but as an index investor, which I do have some of my money in that, it looks likely that investing at current valuations will return less than the historical average of 7.5%, and more likely it's going to be low single digits. Why do I think that? Well, because although the world will continue to be a better place in the future, returns just can't outstrip the production in the long term. So with low single digit GDP growth, along with valuations reverting to historical averages, returns should be expected to be low single digits over the medium term from here. Now, that's of course not to say that we might go through periods of excessive valuations again, but it is more likely that the valuations normalize lower to reflect the underlying production of the country. Now, to think that the Fed won't try to soften this impact on the economy, well, that would be pretty naive. So I would argue that it is an impossible act to try and predict the speed or the correct timing of any pullback. So this is the stuff my uncle and I agreed on. Plus, if Buffett has an indicator for this concept, then I can get on board with this theory. But if index funds look likely to underperform in the medium term because the valuation of the index is still too high, that now leads me down to bonds, because bonds are a very, very conservative, safe investment for most people trying to conserve their wealth. I think once you're like 60 years old, just not losing all your money is a fair strategy. Now, if you are looking at bonds more seriously, you can do this inside of Interactive Brokers and make the trades. This is my broker of choice because, like I said before, it's a public company and it's got a solid balance sheet and a long track record. I've said all this stuff every time on my channel, and it's just not like the Robin Hoods that are essentially startups. There's a link in the description and you can take it for the demo account for a spin. Other interesting things in my description as well, like my Discord community, where you can talk to me directly and things like that. We talk about investing ideas there. It's a lot of fun. And if you're interested, just take a read through the description for all those different things. Now, when it comes to low risk investments, the 10-year government bonds are considered risk-free. That's the US version of it. And it's even called the risk-free investing standard. It's like the measuring stick that everything else is measured against. Now, right now, it's December 2022. And I can buy the 10-year bond for a yield of 3.6%. Now what happens that is if you buy this 10-year treasury today, over a 10-year period, the face value of the treasury note changes with the yield. For example, if I buy a treasury note at the 3.6% and the yield in say 2 years time for the treasury bond is changed to 5%, interest rates have gone up to 5%, well, my 3.6 bond is not very good, is it? Because I can now just go out and get 5%. So it's going to be hard to find someone to sell it to because they can just go out and get that 5%. So if I paid $100 for that 3.6% bond, maybe I can sell it for like $85 to someone, but it's not going to get my $100 that I paid for it. So that means that the person who bought it off me spends $85, gets a 3.6% yield payment each year, and then at the end of the 10-year period that I started, he would get $100. So an extra $15 to go with that 3.6%. That makes up for the 5% yield he could have got if he just bought the bond himself. And this might appeal to someone because they only have to wait 8 years instead of the full 10 years. And if you're looking for some sort of arbitrage here, well, this market dynamic is actually super efficient. There are hardly any arbitrages here in this space. It is, I think, the most liquid market in the world, even more liquid than the stock market. I think it's even like twice as big or something in terms of trade volume each day. So it's super efficient. So don't try to chase arbitrages in the bond market. Anyway, Let's talk about now what happens if the interest rate falls from that 3.6%. Well, if you think that is going to happen, like my uncle thinks it's going to happen, well, this is how the expected returns would look in a 2-year period. So as you can see, as interest rates decline, the total value that you get for your bond in 2 years' time starts to increase because people are willing to pay up for your 3.6% yield. So if interest rates were 1%, they're going to pay up maybe $115 for your $100 bond because they want to get the 3.6% better than the 1%. So your total value in that 2-year period actually turned into a nearly 12% return. So what the play is here is that if rates go higher, well, you don't worry about it and you collect the 3.6% for 10 years, and that's as bad as it's going to get. So 3.6% is the baseline here. You're not going to get worse. Sure, you'll miss out on some opportunity cost if bond rates go to like 7% or something. So that is the risk. But the worst that can happen is 3.6% per annum. But if rates start to fall, the value of the bond starts to increase. And as the rates fall lower and lower, the value of the bond increases higher and higher. This table shows how this would work. I've done the calculations, and this is how it would work from the 3.6% per annum, plus the extra value of your bond because it's going to be worth more in the future. I've added all those together to get a total value over a 2-year period. Now, I really can't say with any confidence that bonds will go lower. So here is how I would calculate an expected return. So what I've done here is I've added a column called expectation. So this is what I guess my opinion is on what the likelihood of interest rates going to these levels would be. Because I have no idea what's going to actually happen, I think it's 50-50 that rates go higher. But if rates go lower, that's where things start to get a little interesting. So what I've done is got the expected return percentages and multiplied it by the result value and added it all up to get a total expected return of 6.1%. So as you can see in the table here, I've got there's a 5% chance of 0.5 interest rates, and then a 50% chance of 3.6% and higher. There's a bit of mathematics going on there, but eventually what it comes out to at the end of this, if you could do this 100 times, make this bet, I think you could expect a 6.1% return, because if interest rates drop lower, your returns get higher, and that scenario could happen. And like I said, if you could do this 100 times, you should get about 6.1%. So essentially, because half the time I'm expected to get 3.6%, and the other times I get progressively more than that. Now, I did the same test with my uncle, who thinks it's just far more likely that interest rates in 2 years' time will need to be lower, because he thinks that the economy is headed for a recession and the Fed will have to lower rates. And his expected return would actually come out to about 7.3% if you could do this bet 100 times. So even though he thinks it's going to happen, it's only a 7.3% expected return, and mine was only 6% essentially. So I thought this was just an interesting way to look at bonds. If the bond prices go up higher, well, the expected return actually gets better for a shorter 2-year trade. Plus the floor in this bet is currently 3.6%. That's the worst that can happen. So if bond rates are 6% or 8%, well, that is the worst case scenario, but you could get far more than that if you just want to do it as a trade and interest rates move lower after you buy the bonds. I think this is pretty interesting. I'm not acting on any of this information, but it's another tool for my tool belt. I appreciate you staying to the end and getting through that math with me. Let me know what you think about bonds and maybe this trade, and I will see you next week.